Today we're going to cover one of our most commonly asked questions, the question of the guaranteed 4% interest rate on a whole life insurance policy. Hi, I'm Olivia Kirk.
I'm Tim Yurek. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, please be sure to subscribe to our channel and hit the bell to be notified when we upload new videos. A lot of times people get a whole life insurance policy delivered and they'll look through the contract and they'll say, hey, I don't see anywhere in here where it says I'm guaranteed the 4% rate of return I was told about.
And that's probably one of the most misunderstood concepts of whole life insurance. Now, understand, you'll get somewhere between 3 and 5%, and certainly 4% is right in the middle there, as an internal rate of return on the policy. But the 4% guarantee is not a guaranteed interest rate. It's literally a discount rate. And what happens is when you buy a whole life insurance policy, the insurance company makes two promises. Promise one is that they'll pay the death benefit whenever you die, as long as you own the policy. But promise two is that once you reach the age of maturity, typically age 100 or age 121, they will have a pile of cash equal to the initial face amount of the policy waiting for you when you hit that age, again, whether it's age 100 or 121. Now, if you have a limited pay policy, let's say life paid up at age 65, that doesn't mean you'll have the equivalent of the face amount available in cash at age 65. It means premiums stop at age 65 and the cash will continue to grow so that at 4%, the policy will have, let's say, the face amount, $150,000 at age 100.
So you may be wondering where that 4% even comes from. And it comes from the regulation 7702. And recently there were some changes made to this regulation that allowed the discount rate to be lowered as low as 2%. So you may be wondering, what does that mean for a whole life insurance policy now?
Well, basically, if the insurance company is using a lower interest rate, that means everywhere along the line they have to have more cash in order to, because they're crediting a lower interest rate in order to equal the face amount at age 100 or age 121. So consequently, if they're applying a lower interest rate, the cash that they have along the way has to be greater. So what that means is your cash value everywhere along the way should be higher.
So if you're designing a policy for cash value accumulation, the changes in the regulation aren't necessarily a bad thing. But what's the downside? Well, prior to the 7702 changes in 2021, $100,000 of death benefit may have cost $4,000 per year. After the changes, that same death benefit may cost you $4,800 per year. So with it, you're losing death benefit. The death benefit is going to cost more, but that's not necessarily an issue when you're building the policy, designing it around accumulating cash.
So it's really important to know whether or not you're buying a policy for death benefit purposes or for cash accumulation. And when we're designing policies for people, it's incumbent upon us to determine whether they're looking for cash accumulation or death benefit.
If you'd like to learn more about this topic, feel free to visit our website at tier1capital.com and schedule a free strategy session. Also, if you like this video, please be sure to give it a thumbs up and don't forget to subscribe. Leave us comments down below on what you think about this topic. And remember, it's not how much money you make,
it's how much money you keep that really matters.